All right, everybody, welcome to week 15 of Selling Weekly Lottos. Every week I sell what's the equivalent of lottery tickets in the stock market to gamblers by using options. That's how I make passive income. All right, every week we do the disclaimer. So number one, all my positions are covered. I don't use margin. I don't sell naked calls or naked puts. Covered calls and cash secured puts only. All right. Number two, I'm happy to sell my shares or buy more shares if I get a sign. Totally cool with it. All right. And then number three, this is considered risky. This is not free money. There is a chance to lose, and that's why you're getting paid. You're taking the risk. All right. That being said, the winner this week is me. I made $1,181 using $70,500 in collateral. That's a 1.67% yield. Let's take a look at my positions. Boom! I've talked to you about the covered strangle before. Did it again this week, this time on hood. A 125 call and a 115 put. Both sold that expired the same day, and I won on both of them. All right, let's take a look at my benchmarks really quick. Bazam! Let's not spend too much time on this. I did increase my income and reduce my average risk, which is what I'm going for. All right, but because I had a lower income this week than my average, my income-related benchmarks are down. So my average weekly income is down and my annualized income is down. But because I had a higher yield, my average weekly yield and my estimated annual percentage yield is higher. All right, and I'm okay with that. I'm happy with that. All right, let's take most of the time today to really break down and give you the details about the covered strangle. I've talked to you about this before. This is the third time I've done this. This is my favorite way to make passive income. All right, let me give you the details on exactly how this works. All right, so first things first, got to have 300 shares of Robinhood or buy them. All right, let's just keep the numbers simple. Let's say I got them for $120. So I bought 300 shares for $120. That's $36,000 that I used to buy the shares. I used those 300 shares to sell 3 covered calls at 125 strike. I got $2 per share, so that's $600 total. All right. Immediately after that, I also sold 3 cash secured puts at 115 each. That's $34,500 that I used to agree that I'll buy the shares at 115 each. So the covered calls, I agreed to sell them at 125, and the cash secured puts, I agreed to buy them at 115. Now, the beauty of this strategy for me is one of them has to win, okay? They can both win, but they both can't lose, because on the expiration day, the price of Robinhood can't be both 115 and 125 at the same time, all right? So one of them has to win, all right? But the thing is, guys, you can still lose overall. You can still lose overall. The way you can lose is by if it goes down a lot. So if this was a trade, you would start losing at 116. You can do that by taking the premiums of your calls and your puts and subtracting them from the price you got the shares. So at 120, you would reduce 120 by the $2 that you got for the calls and the $2 you got for the puts. So that's 116. So if this was a trade and you were planning to just exit the position completely, 116 is your break even. At any point below 116, that's where you would be better off if you just didn't do any of this. For me, as an income strategy, my break even I consider at 111. That's where you take the $4 that you get for premium and reduce it below the put strike. So 111, so 115 minus 4 is 111. That's where I would consider this whole thing worthless, because I could have just got the shares cheaper. All right. So total loss potential here is $69,300. So that's $70,500 that you use minus the $1,200 you get in premium. That's your total loss potential. That's if Robinhood goes to zero in a week, you lose $69,300. That's technically the maximum potential loss. Very unrealistic for any stock to go to zero in a week, but it is the true maximum potential loss. All right. Let's talk about the potential of gains. So the maximum gain you can get is if the stock goes to $127. That's where your 300 shares will cap out. You'll have to sell your 300 shares at 127 because the 125 strike. You add $2 to that. It's 127. So 127 minus 120 that you got the shares for times 300. That's $2,100 plus the $600 that you get for your puts expiring worthless. That's $2,700 in maximum gain. So you can gain $2,700 and you can lose $69,300. So asymmetric risk there, guys. That's why I always say in the beginning, you can lose. And it's an asymmetric strategy where you could lose a lot more than you gain. All right. And then there's a third situation that can happen, which is in between, which is what happened for me. So let me show you the visualization, the chart. All right. Hoya! All right. I don't usually show charts that much here, but I want to visualize this for you guys. So right here, the green line is the call trajectory and the red line is the put trajectory. So this isn't technical analysis. I wasn't predicting the price that was going to go to these positions. All right. This is just what I call a trajectory line where I put the start where I sold the option, the day and the price that I sold the option. And then the end is the price that it needs to get to for me to either get a sign on my calls or get a sign on my put. And as you can see here, the ideal situation actually happened where it followed the green line, but just a little bit less. So both my calls and my puts expired worthless pretty much. I did buy them back one day before because I wanted to unlock my shares and my collateral. And I got the shares and the collateral back, and I got pretty much like a 90%, 95% profit on the contracts. But the ideal situation happened where it went right in between and followed the green line. So in that case, you'll get, if you allowed them to expire, you would have gotten the $600 from your calls expiring worthless, the $600 from your puts expiring worthless, and you would have got to keep all your shares and you would get your collateral back. And that's what I consider the best possible situation. I didn't know that's how it was going to happen, but it happened the best way possible for me, and that's why I like the covered strangle. So yeah, you know, hope you learned something this week, guys. Thanks for watching. Let me know if you have any questions on this, and I'll try to explain it. Some people ask me to explain it like I'm 5. I'll try my best. I still don't think a 5-year-old can understand this, but I'll try my best. Feel free to ask me any questions in the comments, and I'll see you for week 16 next week. Peace.